welcome to another one of our Rand Swiss weekly wraps. As usual, we'll cover three things that happened in the last week and discuss how they affect you in your investments going forward. This week is basically going to be three aspects of the same particular story: the banking situation globally and how that's going to affect central banks, etc. The first one is going to be the CPI number that came out recently. Then we're going to talk about the actual banking crisis with the banks like Silicon Valley Bank, Signature Bank, and Credit Suisse. And then finally, instead of the normal topic, I'm just going to cover the bond market and why you need to be concerned about it and what it might be saying about the dangers in being in the banking system at the moment. So let's start off with the CPI number. US CPI came out this week, 6%. The 6% number was as expected. It's a drop from 6.4% the previous number, but it's still significantly higher than the 2% target that the Fed wants to get to. The Fed basically has been really focused on fighting inflation, and if they want to get down to that 2% number, they need to be keeping interest rates higher for longer in order to slow growth, increase unemployment, blah, 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 to get inflation down. Another thing in that inflation number that was important was the fact that we saw the core CPI number. This is the CPI number, the inflation number, excluding volatile items like food and energy and that kind of stuff. Now, why is this an important factor? Because we are seeing inflation at the moment in the US becoming more and more sticky. Remember, I talked about this a number of times. The price of oil goes up and down. The price of cars go up and down. The price of wages does not go up and down. It goes up and tends to stay up. People are very, very reluctant to want to accept lower wages. They don't basically give back increases they've had in the past. In fact, there's a common saying in management, basically, if you had to reduce your wage bill by 10%, don't go and get a 10% reduction in wages. Fire 10% of the people, because yes, the 10% of the people that are fired are going to be a problem. They're going to be unhappy and so on. But the 90% that remain is not going to be totally demoralized. You reduce wages across the board by 10%, everybody's going to be much less willing to work, much more unhappy. And you're going to have a lot bigger problem than just firing 10% and keeping the 90% what they were. If we are seeing wages, core inflation, wages to compete with core inflation getting higher and higher and becoming, closer to what the inflation number is, what we are going to be seeing is stickier and stickier inflation, and this is a problem. And the Federal Reserve is going to have to deal with this going forward, because if we don't deal with this, the eventual solution to this kind of cost of living allowances, they call us and so on, where wages increase as much as the inflation increases, is effectively going to be very, very painful. If you want to break this link between inflation and wages, and once they get really linked quite strongly, you're going to find it very difficult to do. The next topic is what's happening in the banking sector. Okay, so Silicon Valley Bank, obviously bankrupt. Signature Bank, another big bank, also gone down. They're smaller than Silicon Valley Bank, but they were in the top 50 banks in the US. Then we also had a huge bank, which is Credit Suisse, also in trouble this week. Now, what happened at Silicon Valley Bank, and why is this important to you, and what's happening in the banking sector right now? Why are all these things in trouble? Okay, when Silicon Valley Bank had these problems, what happened was they had a mismatch between the amount of money they had freely available at the moment and the amount of people that wanted to withdraw that money. They would normally go out and sell some of their bonds, and they weren't able to do that because the bond price was down. We'll talk about why that is in a split. In that scenario, what's happened is that the bank didn't have enough money to pay off its depositors, and therefore was taken over by the government. Normally when this happens, the first $250,000 of any account is guaranteed by the federal, the government's basically insurance policy. You have a guarantee, an insurance on $250,000. Anything above that, you are a creditor to the bank, and you may or may not get enough money back. This weekend, what the government did was it came out and says, no matter how much you have in there, we're guaranteeing the entire amount. No more is there a $250,000 limit. There's an unlimited amount of money that we'll guarantee at a bank if it goes bankrupt for the depositors. Okay, of course, shareholders, management, and so on are going to lose their shirts, but the depositors get refunded in full. This is one of the biggest moves we've seen in banking probably since the creation of the Federal Reserve Bank, the US Fed creation, about 100 plus years ago. Because right now what has happened is every single bank in the US is effectively now being backed by the full faith of the US government. So the US government has stepped in and said all deposits in any US bank are guaranteed. Okay, that's a big deal. What was the situation before? The situation before was in 2008, the big four banks became guaranteed, like JP Morgan's and Bank of America and so on. Those guys became guaranteed by the US government because the US government said they were too big to fail, that they were not allowed to fail because they'll cause a systematic risk in the US economy, and therefore we're going to step in and protect them and make sure they don't go under. Now what's happened is that they've applied that same kind of protection to every bank in the US. And why did they do that? Well, what happened over the weekend was you saw a lot of pressure coming through from Silicon Valley insiders, people with a lot of noise. There's a podcast called the All In Podcast, which is one of the biggest podcasts in Silicon Valley and technology in the world. And those podcasters are very involved in the industry, and they basically really ratchet up the following argument. The argument goes as follows. We know that the big four banks are backed by the US government. You have money at JP Morgan, you're not going to lose that money, no matter what happens. We know if there was a haircut given to Silicon Valley Bank, that any bank besides those big four banks, your deposits could lose money. So even a haircut of as much as, say, 5%. So let's just say you put $1 million in, and then the first $250,000 were protected, but then 5% of whatever is left over is not protected. So you lose about $40,000, okay, out of $1 million. Less than 5%, after you get your guarantee and so on, calculated there. Even that small haircut there, it was logical at that point for every single account of more than $250,000 to move the excess amount of money over to a big four bank. Across the entire, I think, 4,000 or 5,000 banks in the US, every one of those banks would not have a deposit account with more than $250,000 anymore. And now Silicon Valley Bank was a bit different. It had more money above that limit, and 90% of the money apparently at the bank was above the $250,000 limit. But most banks have 10, 20%, 30% above that limit. Okay, so if you had to have most banks having to lose 10, 20, 30% of their deposits, guess what? The banking system would collapse. They don't function with that kind of high level of withdrawals in a short period of time. And by these podcasters really pounding that idea through, trust me, every single business, every single high net worth individual in the country knew that. Obviously, it's not exactly a very difficult leap to make, and they're just pointing out the obvious, but they were making this case very clearly to the government. Either you give a full 100% backing to Silicon Valley depositors, or what's going to happen is come this week, we will see massive withdrawals from every single regional bank in the country, possibly causing tens or maybe hundreds or even thousands, who knows, of banks to have a similar kind of crisis as Silicon Valley Bank did, which would be a huge problem. And would take tens of billions, hundreds of billions, maybe more to solve. Probably hundreds of billions, maybe or $1 trillion to solve probably down the line. As opposed to basically just backstopping Silicon Valley Bank, making sure every depositor had no chance of losing money. A few tens of millions, that's what it would cost. And the government basically agreed to that. But agreeing to this one small step, they've taken a gigantic leap, because now they've set the precedent that every single bank deposit is backed by the US government in the entire US. And unless there's massive regulation that comes along with this here, it's going to be quite a big problem going forward. And if there is massive regulation, how is the regulation really going to be implied? Is it going to be the right regulation? Is it going to be the right levels and so on? So this has created a totally different US banking system, like I said, than it was last year. And this basically, like I said, is one of the biggest changes in banking in the US since the creation of the Federal Reserve over 100 years ago. Over in Europe, pretty much the same thing has happened. Credit Suisse, which is a far larger bank than the regional banks in the US, it's a really, really systematically important bank, saw its valuation fall by more than 30% in one day. There is real fear about the viability of the bank. And its biggest shareholder, the Saudis, basically said they're not going to be contributing any more to try and rescue the bank, because they've already put some money in and they're looking like they might be losing it. So in that scenario, what happened is that the Swiss central bank had to step in and backstop Credit Suisse and be like, what the US government did for Silicon Valley Bank. And they were able to do that, and the share price spiked up by double digits the next day. And they are able to do that because they are a big, powerful, developed market bank. And I think that is an important factor to consider. What we are seeing right now is that because of some issues, and I'll cover that in a minute, around bonds, we're seeing weaknesses around banks all over the world. Okay? And the solution right now seems to be your government steps in and backstops your bank. But not every government is strong enough to do that. The Americans can do that. The Saudis can do that. The Europeans can do that. The Japanese probably can do that. The Australians can do that. Get the kind of idea of what I'm talking about. The developed market countries can do that. The developing market countries may not be able to do that. They may not have the ability to backstop things, especially if the bank's liabilities may be in foreign currencies. They may not have the ability to step in and basically protect depositors across the board. And that creates a huge issue around the variability and risk between being in the developed market and the developing market. And if the risk of being in the developed market is much, much lower than developing markets, the returns you need to have in the developing markets need to be much, much higher to compensate you for this extra risk. Which means that there's going to be more and more pressure on developing markets, which are already under pressure with stuff that's happening around Russia, around food security and blah, blah, blah. Okay? This is a really key issue, that if your country can't support your banking system, for whatever reason, maybe you can't borrow in that currency enough, maybe that currency is, or the country is too vulnerable to foreign currency fluctuations and so on, your banking system is much more risky than developed market banking systems. And therefore there should be a much higher premium that you demand for investing there. It makes the cost of borrowing in the country, the cost of investing in the country, significantly higher. And another thing to be considered is this fact here, that because we have in the US government have to step in and protect SVB because of the bond stuff, it may cause them to change the rate hike cycle. And for the reason I'm going to mention right now, I'm going to go through a little education about bonds and why this is happening at the moment. Okay. The final thing is a deep dive into bonds. I'm going to give you a little lecture about the relationship between bond prices and interest rates. The simple relationship is this: the higher the interest rate, the lower the price of a bond. And the reasoning is as follows. Okay. Imagine you basically went and bought an iPhone, say 10 today. It's an iPhone 10, $1,000. You buy it today. The moment you pay that money, Tim Cook comes online and says, tomorrow we're going to start selling the iPhone 6, also for $1,000. Your iPhone that you just bought was $1,000 when you paid for it. A minute later, when it was announced that the iPhone 6 is coming out, also for $1,000, what happens to the value of your iPhone 10? So iPhone 10 you have right now, the iPhone 11 has been announced the next day. What happens to the value of the iPhone 10 that you're holding when the iPhone 11 is announced the next day? Okay, for the same price as you paid for your iPhone 10. Obviously, your price of iPhone 10 goes down. You see that happening all the time. When the new versions of a car come out, when the new versions of a phone come out, the new version of any appliance comes out, the older version goes down in value because the new version is usually better. Now, when it comes to bonds, understand the bonds are also an instrument, almost like an appliance that do something for you. What does a bond do for you? A bond is something that gives you a future stream of income. So let's just say you buy a $1 million bond, $1 million bond, and it has a 2% associated interest rate. What you really get, and it's 10 years, okay? So what that means is every year for 10 years, you get 2% of a million, okay, coming to you. That's $20,000 every year for 10 years. And at the end of the 10-year period, you get your $1 million back. That's what that bond is. It's a 10-year, 2% $1 million bond. That is what that bond means. If the same issuer offered you now a bond with a 5% interest rate, so it went from 2% to 5%, what does this bond now do? This bond now gives you 5% a year for 10 years, $1 million at the end. That is what this new bond does. 5% a year for 10 years is $500,000. 2% a year for 10 years is $200,000. $500,000 is worth more than $200,000. So the bond basically that you have coming to you is going to give you more. It's like the iPhone 6 gives you, so iPhone 11 gives you more than the iPhone 10. The bond with a 5% interest rate gives you more than the bond with a 2% interest rate. And so when they announce the bond with a 5% interest rate, the bond with a 2% interest rate you have is going to be worth less. Okay? Does it make sense? So if you have a increase in interest rates, what it does is it makes bonds bought at lower interest rates look worse in comparison and then become cheaper. So what happened here is that you look at the example of Silicon Valley Bank. Silicon Valley Bank, when they bonds, when interest rates were 2 and 3%. Now interest rates are 5%. They may have paid like $1 billion for those bonds. Okay? And they were fair value when they bought them at 2 or 3%. But now when interest rates is 5%, it's like owning a bunch of iPhone 10s when the iPhone 11 has been announced. because there's a better bond available. You can go take $1 million or $1 billion and buy this 5% bond, which is much better than the 2% bond. Therefore, the price of those bonds has gone down in valuation. And Silicon Valley is not the only bank that's done this. Every bank basically does the same thing. The way a bank works is as follows. Banks get money from depositors. They lend some of that money out. They keep some of the money in reserve. Okay? So you get money in, you lend some out, you keep it in reserve. Why do you keep it in reserve? In case the depositors come back and ask for money. So you put your money in the bank, you're not going to go ask for the entire amount like at any given day, but you ask for like 10%, 5%, depending on what you need in that day. So the bank needs to keep a little reserve available. Okay? Those reserves, okay, are like a safety margin. Now, if you have a bank like Silicon Valley Bank, which has billions and billions under management, or like JP Morgan, which has tens and hundreds of billions under control, if you keep those billions just in cash, guess what? You're foregoing a lot of interest income. You put $10 billion in the bank and there's no interest in it, you're just sitting in the vaults. Hell, if you bought a bond that was like giving you 2 or 3%, hell, that's hundreds of millions over a decade or so. So every bank has the incentive to go and buy bonds with the reserves they have, because that's where you get the money. That's where you get the next amount of money from. Every time that you look at any bank here, there'll be a certain amount of their reserves that they're using to buy bonds, because those bonds give you an interest rate, and that interest rate is income that you would not have earned otherwise. The question is, how much of those bonds do you buy? How long a duration of the bonds you buy? And when do you buy it? Okay? How much of the money that you take away from cash do you go towards bonds? The more you put towards bonds, the more money you make. Okay? The more you have in cash, the safer you are. How long is the duration? The shorter the duration, the less money you make. But the safer you are, because you can always get out of it quicker, a short duration bond. Long duration bonds, stuck for longer, more fluctuations with interest rates and so on. More dangerous, but they'll give you more interest rates. Okay? So you make more money. Okay? And at what point are you buying these things? What's your forecast for the future? Do you think the interest rate is going to go up to 20, 30% in the next couple of years? Or you think it's going to go back to 1 or 2%? Depending on that, depends on what you're going to do. What Silicon Valley Bank had done is a couple of things. Firstly, it put too much into long duration bonds. And the next thing is it had too optimistic a view on interest rates. They thought interest rates were not going to rise by as much. Perfectly logical. I mean, if you listen to what the Federal Reserve was saying at the time, that is exactly what they were saying. They were saying, we're not going to go up this high. Inflation is transitory. Interest rates are not going to be rising so much. That was until a couple of years ago. And then they started this massive hiking cycle that we're seeing right now. So Silicon Valley Bank, listening to the US Fed, bought government bonds and other bonds. And those bonds became less valuable as interest rates rose, because now new bonds are much, much more attractive. When new bonds are more attractive, the price of old bonds will go down. And so when they basically on their books may have had $1 billion or 10 billion or whatever bonds, those bonds were not worth that, because quite frankly, the new bonds that were available from issuers were giving you high interest rates, making the old bonds less valuable. And if you had to look across the entire banking sector in the US, there's apparently $620 billion of losses associated with this kind of phenomenon that's not recognized in the books of the banks. Because the banks, especially the smaller banks, don't have to have the same regulations around reporting mark-to-market losses. So they could buy a bond for $1 million or $1 billion, whatever it is, and even though in the real market they could not go and sell it for $1 million or $1 billion, they basically still have that on their books for $1 million or $1 billion without adjusting for the high interest rates. And because of this, it's quite likely that there's multiple other banks out there that have massive losses that are not being seen at the moment. And maybe those losses are significant enough that if there is a withdrawal in their particular sector, that they will be experiencing the same kind of crisis that Silicon Valley Bank has. And guess what? The US government wasn't the only government that raised interest rates. Europe did it. The UK did it. Japan didn't do it, but most of the rest of the world did. In that environment, what are the chances that other banks out there also have the same problem that Silicon Valley? What are the chances that other banks made the mistake of putting too much money into bonds, basically having too long a duration for their bonds, and not calculating exactly what the valuation is going to be changing with interest rates, not predicting what the interest rate cycle is going to be. Firstly, nobody predicted that interest rates would go as high as they are right now. The majority did not. And if you look at what the bank forecasts were 2 years ago in terms of interest rates right now, they were not this high. The second thing is that if that's the case, and you weren't thinking there's a big danger of interest rates spiking, hell, why not put some more money towards bonds, because you make a bit more interest and you make a bit more money. Okay, the incentive is always there to put more money for a longer duration. So if they weren't predicting this high spike in inflation, it's quite likely that a number of other banks have made the mistake where they've overexposed themselves to bonds that are currently valued less than they should be. Okay, and if that is the scenario we're looking at, guess what? It's not over until basically every bank, central bank in the world, comes out and very fully backs their banks for all the deposits in there. It's going to be a bit of a rough ride. You want now, if you were in the European Union, if you were in anywhere in the world, and you had a couple $100,000, in the European Union, by the way, I think the limit is 100,000 euros. In the US, it's $250,000. If you had more than that amount of money in a European bank right now, you'd be saying to yourself, hey, why don't I go to somewhere else? Why don't I put money into a bigger bank, maybe split it among various other banks, maybe put it in the US banking system because they are, totally insured. If you're a company out there, you'd rather have your money at a US bank than a European bank, unless the Europeans come out and fully back their banks like the Americans did. That's the danger we are seeing right now. And what if you're in the developing world? Well, then tough luck. Your banking authorities are not going to have the money to fully back you up. Okay, that's me for the week. Look forward again to speaking to you guys next week. Cheers.